Corporate finance practice problem using OneNote. Dividends in arrears paid off through the issuance of bonds. Get ready. It's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1729 Dividends in Arrears Paid Off Through Issuing Bonds tab. Also note when using OneNote, look at the Immersive Reader tool. Our problems up top will be in the text area down below, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations down below, focusing in on the preferred stock and the preferred stock dividends in particular, remembering that the preferred stock and common stock comparison with relation to the dividend is that usually the preferred stock would need to be paid before the common stockholder, and if the company decides not to pay dividends, then there should be an accumulation generally of the preferred stock, once again still needing to be paid before the common stock. What is the benefit on the common stock side of things? When times are good and income is going up, they might decide to increase the dividend, and the common stock dividend might increase past a certain point, might increase, whereas the preferred stock dividend will be capped, as well as, of course, the common stock being the voting shares and whatnot, the owners of the corporation, the value of the common stock then increasing as well. So when times are bad, you kind of like being on the preferred stock side of things because you're more likely to get paid before the common stock, and when times are good, you kind of like to be on the common stock side of things because then you typically will have a more upside in terms of dividends and or value of the stock. So, and if you don't pay, of course, any dividends, you could decide not to pay the dividends, but then there's an accumulation of the preferred stock, once again, typically needing to be paid off before you go to the common stock. Now, obviously, if there's dividends that build up, the common stock, as the owners and the people that have voting power and pressure over the board and whatnot, are going to be probably a little bit upset and say, hey, I want some dividends at some point in time. We need to take care of this preferred stock issue and see if we can basically, get us some money back here at some point. So in this case, we're going to do the dividends in arrears calculation and then see if we can come to an agreement to basically pay off the outstanding portion of the dividends in arrears by issuing bonds to take care of that. So that's going to be the general scenario. So in the more specific scenario, we have the dividends in arrears for 5 years, so they haven't been paid for 5 years. The preferred stock outstanding, $500,000. We're going to say annual preferred dividend per share is $3 per share. And then once we calculate how much is owed, we're going to try to come up with a plan. We're going to assume the plan's going to be coming up with, we're going to say, hey, we can't pay the dividends in arrears, that's too much, but possibly we can issue bonds. How about that? If we issue bonds for them, can we come to a deal on that? So the plan is to compensate the preferred stockholders with a percent of the dividends in arrears, the 80%. So we're going to say we're going to pay off 80% of the outstanding dividends by issuing these bonds. And the bonds, then, we're going to have to calculate the bonds back to the calculation of the bonds, which is always good times. Paid by issuing the bonds, the rate is 11%, maturity is 20 years, and the par value per bond is going to be $1,000. They're going to be semi-annual. Market rate is going to be the 9%. So we're going to have to value the bond and then think about how many bonds we're going to have to issue in order to pay off 80% of the outstanding dividends that are in arrear or the arrear age or whatever. So we're going to go down here. So let's calculate the dividends that are outstanding first. So this is what we're going to have to pay. So the annual dividends is $3 per share. How many shares are out there? 500,000 of the preferred shares. So 3 times 500,000, that's going to give us 1,500,000. That's the annual dividend. Remember, that would have to be paid off before you would have to be able to pay off the common stockholders. And it hasn't been paid off, which means the common stockholders, you would think, haven't gotten paid either for 5 years. So that means, and it's going to accumulate upwards if it's not paid off. So you can decide not to pay it, but then you don't get to pay the common stockholders, and it's going to accumulate is the general pattern. So we got the 1,500,000 times 5. That means that we owe 7,500,000. So we're going to see if we can come to an agreement with the preferred stockholder to say, hey, we can't really do this. We need to take care of this because the common stockholders are getting angry, and let's see what we can do. Can we pay you off 80% of it? Can we make a deal on that and basically issue bonds for it. And if that was agreed to, we could say, all right, the dividends we just came to for the dividends arrear age, or the dividends in arrears, or the preferred dividend accumulation over the time period it has not yet been paid, is $7,500,000. And we're going to take 80% of that. That's going to be the $6 million. So that's what we're going to have to pay. We're going to have to pay it. We don't have cash. We're going to issue bonds in order to pay this. So we're going to say, all right, we're going to issue bonds to pay this out. So we're going to calculate the value of the bond and then determine how many bonds we would have to issue in order to pay this off. Now, note that if you want to go over this kind of problem in more detail, we have a section on bonds. If you want to go over the present value calculations in more detail, we have a section on present value calculations in which we do the present value with mathematical formulas, with tables, and with Excel. Here, we're just going to do it with Excel, give the idea of it as we go. But the general idea to value the bonds would be is we're going to take the value or the annuity of the interest payments, 40 of the interest payments, because there's 20 years here, but they're semi-annual. So we're going to pay every 6 months. And the rate, you can think about it this way. You can say the 0.11 is going to be the rate, and you can divide that by 2. That's one way you can think about it, divided by 2, and that's going to be the 5.5%. And that's going to be the rate that you will have on every 6 months or half a year times the face amount of 1,000, and you would do that for 40 periods. Or you could think about it this way. We got the 1,000 times the 0.11, 11%. That would be 110, but that would be for a year. So I'm going to take that and then divide it by 2, and we're going to get to that 55 again. So that 55 would then be paid for 40 time periods every 6 months, because there's 20 years times 2 would be 40 periods for every 6 months or every half year. So then we're going to have to pay also the par value at the end of the maturity in 20 years or in 46-month periods. So let's do that down here. We're going to take the present value of the interest, which is our annuity payment for the $55 paid every 6 months. It would look something like this if you did it in Excel, negative present value, the rate. The rate would be the market rate at that 9%. So that's going to be the expected market rate, but that would be for a year. So it's going to be 0.09 divided by 2, which would be 4.5, which we could see in the formula. We just simply took that and divided by 2 here. And then comma, the number of periods would be 20, but semi-annual periods, therefore it's going to be 40. We take the 20 times 2, as you can see here, and then comma, and then we've got the payment. The payment would be the what we calculated before, the $1,000 payment times the 0.11, but that would be for a year divided by 2. So that's what we have here. This times this divided by 2. That means the present value of the interest, annuity of the interest payments, $1,012.09. And then the present value of the 1,000, bringing that back to the current time period, looking something like this. Present value of the rate, using the market rate again, 9% divided by 2, because it's for every 6-month period. The 9% is a yearly rate, comma. The number of periods would be 20 times 2 or 40. So this times 2, and then comma, comma, because there is no payment, because it's not an annuity, but rather a present value of 1. Therefore, we take the future value, which is the 1,000, bringing it back. That gives us the 171.93. Adding those two up gives us the bond value of the $1,184.02. So then we could just say, okay, now how many bonds would we have to issue then in order to pay off that 80% that we said we were going to pay off? So we have this $6 million up top, and we now value the bonds that we're going to be issuing at this premium over the par value at the 1,184.02. So that means we'd have the 6 million, one too many zeros, divided by 1,184.02, and that's going to give us our 5,067.50 about. There's rounding that's involved here. So, and obviously we couldn't really issue like a partial bond here possibly, so we'd have to do some rounding in terms of how many bonds it would take for us to basically get this done. But that's the general round number there, or that's the general idea. So quick recap, we said, okay, we have these outstanding dividends that we need for the preferred stock that we got to pay off so that we can start possibly paying some money to the common stockholders. We owe them, we determined that we owe them the $7,500,000. We tried to come up with a deal to pay off 80%, which would be the $6 million. And we said we're going to issue bonds. To do that, had to value the bonds to see how many bonds it would take for us to issue this off. And then we decided that was 5,067, 68 bonds about at this value for us to hopefully take care of that outstanding value or dividends payable for the preferred stock. So hopefully we could start paying, dividends to common stockholders at some point in the future.